All right. Today I want to take a look at the S&P 500 and the NASDAQ 100 E-mini futures to go over the possibility of a bull trend in February. We already talked about the bearish possibilities, and it's important as price action traders to understand both sides of the trade, so it is going to be important to understand the possibility of a bull trend. But first up, let's take a look at the S&P 500 E-mini futures chart. So let's crack open this chart and see what's going on in the stock market today. All right. So the last time we looked at the E-mini futures, we were going over the possibility of breaking through this resistance right around 40.80. And I did tell you that was the resistance the bulls needed to break to confirm the bull trend. And now you can clearly see the bulls are 3 days above that level, and we do have a bull trend. So we talked about the possibility of a rejection to get this inverse head and shoulders before we had the breakout, but the bulls were much stronger and they blasted right through that level without any additional consolidation. Now, the other thing I want you to pay attention to is that we are at the 50% retracement of the bear market. This is typically going to be one of those strong resistance zones as a bear market is transitioning back into a bull market. So I will not be surprised in the slightest if we do see some weakness going into next week, because we are at this very critical bear market resistance level, which is this 50% retracement. Now keep in mind there's a big difference between something being bearish and something simply being a pullback within a bull trend. And right now, because we have the bull trend, there's a very good chance that any pullback is going to be an opportunity to buy the dip, because in a bull market, you have higher lows and higher highs. So to very easily illustrate this, I'm going to take this entire rally that we had since the October lows, and if we just copy that rally to the lows that we bounced from in December, you can very easily see that if we push past the 50% retracement of the bear market, the next likely scenario for a symmetrical market structure would be this next retracement level of the bear market higher, which takes us all the way above 4,300. So there is going to be the possibility that we do get a bullish February as long as we hold above this breakout level at 40.80. You could very simply imagine how a pullback from this resistance could be another higher low above the support trend line, and then we could still go on another face-ripping rally to finish out the next price target higher. Now keep in mind, when you get a market structure that has a higher low into a higher high, sometimes the next wave, which is considered the C wave, is a lot more impulsive than the A wave. So while this arrow to 4,300 could take us out to nearly the end of March, I would not be surprised in the slightest if we get there sooner, because this is more than likely going to be that wave C, which is more impulsive than wave A. So when we talk about the probabilities of a bull trend in February, I would say the probabilities are pretty damn good as long as we hold above the support breakout level, which is going to be 40.80. Now, if we break down below 40.80, then we're looking at the support trend line, which is much lower, which is going to be right around 40.40. So you have a very well-defined risk if you're staying a bull in a bull trend, which is going to be between 40.40 and 40.80. If we break down below that support, yes, there is the possibility this was just a bear market relief rally and we're going for that next leg lower, but it's a lot less likely now that we have a strong established bull trend on this weekly chart. Remember, on the weekly chart, this is a breakout from the bear market resistance, and you're already starting to see at least one closing day above the 50% retracement. So on this channel, we follow price action objectively, and if you're objectively following price action, you know this is a bull trend. It is only those that have a bear bias that are doubting this is a bull trend, because that's subjective. Higher lows and higher highs are a bull trend no matter how you define it. That is the objective definition. You cannot just blindly say a bull trend is bearish because you have some fundamental reasoning to say so. If we lose support, obviously something else is happening, and that is why I always tell you to manage your risk, because if you're losing money on an idea, you're not managing your risk, and you're not trading at that point, you're just gambling. If you are just accumulating short positions because you think the market has to go lower and the market just continues to climb higher, you are not managing any risk at all, and you will eventually blow up your account, because the markets do like to go higher and the markets do like to hurt the majority. And if you still don't think the majority are bearish, all you need to do is just go read the comments below and you can see how many people are still calling for a crash in this market. It is possible they're correct, but if everybody's expecting a crash, it is very unlikely going to do so. So very simply, in the month of February, I think you should stay bullish as long as we're above these support zones between 40.40 and 40.80, because there's a very good chance we are going to start marching higher towards 4,300. I've given you objective reasoning on why this is a bull trend and where to set your risk if you're a bull. And if you want to continue to be a bear, then you need to set your risk right here around this resistance, right around 41.70, because if we start clearing above the 41.70 zone, we are very easily going to start pushing into the 4200s and then the 4300s. Once we get up to 4,300, I think the risk reward for the bears is going to be getting a lot better, which means as bulls, you should be locking in profits as you expect bears to step in at resistance. If you're bullish, you should be buying at support and selling near resistance. And if you're bearish, you should be waiting until we get to resistance, and then you can try shorting the market so that you have well-defined risk. If you start shorting anywhere in this dead zone between 4,155 and 4,300, that is a lot of unnecessary risk to take on because you don't have any clearly defined risk levels. So you really should not be shorting this market unless you are shorting just below the high from Friday. So continue to manage your risk, and I really don't care which direction you're trading in. It is up to you to remain a profitable trader, and it is up to you to manage your own risk. So there is nothing personal about me telling you this is a bull trend. It is simply me stating an objective fact. Next up, we'll take a look at the NASDAQ 100 E-minis, and again, we could see a very similar bullish chart as the ES, except the NASDAQ 100 has a much more bullish pattern, which is a giant double bottom off of this low, which is now getting the confirmed breakout. And this could be a very impulsive rally to much higher prices. So when we talk about the possibility for a bullish February, again, they look pretty damn good to me, because if we get the higher low bounce off of the breakout, we can easily bounce up to the double bottom price target. And as you can tell, it is a very impulsive price target, which could be there by early March or late February. So yes, this looks like a buy the dip market because this is a very powerful bull trend with a very bullish market structure of a double bottom off of a bear market low. If you look at this chart and you don't think this is bullish, I don't think technical analysis is right for you. This is one of the most bullish charts that you could possibly see, and it is not even that difficult to see the pattern. It is a very clear double bottom with a very clear impulsive breakout, and all of these candles are extremely green, which means it's extremely impulsive. If you know anything about price action, you know to always trade in the direction of the impulses, and these impulses are extremely obviously going in the upward direction. So yes, this is going to be a buy the dip market while the NQ is above about 12,340. If we start breaking that, then we still have this neckline at 12,040. But again, these are all very well-defined risk levels. If you know your risk, you can trade comfortably because you know you're only going to lose what you're willing to risk. If you're too scared to risk money and you're too scared to trade in the direction of the trend, trading is not for you anyway, because you're never going to be profitable if you're not willing to put money on the line and you're not willing to risk something for the potential of reward. Now on the flip side of the coin, if you are trying to short the NQ, you need to be shorting below this level right around 12,900. If we start clearing above 12,900, then you're looking for much higher prices into the 13,000s, which could easily take us back up to the 50% retracement of the bear market. So I just showed you the two indices that are the stock market, which is the S&P 500 and this very heavily weighted tech sector in the NASDAQ 100, and they are both looking extremely bullish. So while I do expect a little bit of weakness into the beginning of February because we are due for a little bit of cooling down and consolidation, I consider it a pullback and a bull trend, which means that is a buy the dip possibility, and you have very well-defined risk levels to do so at. So manage your own risk, and it's up to you to decide if you agree with my analysis. But as far as I'm concerned, these are very clear bull trends with very obvious higher price targets that we are very obviously going to reach by March. Next, we'll look at the VIX because the VIX is driving a lot of this bull trend because the VIX has been crushing down below 20. And the VIX below 20 is a market that simply does not have a lot of fear left in it. A lot of bears continue to say the VIX is going to spike because that is what it did during the bear market of 2022. But of course, eventually every bear market is eventually going to end, and that is going to lead to the very early stages of a bull market. So if you continue to expect the VIX to behave the same exact way it behaved last year during a bear market, then you're simply saying there will never be a bull market ever again. Obviously, we know that's not true because the stock market is bullish far more than it's bearish. So the VIX below 20 is continuing to tell us to stay bullish. The next thing I want you to pay attention to is that the VIX is crushing down to lower lows, and we have not seen that trend for the entirety of 2022. This is very clearly the VIX breaking down below the trend line that defines the lower lows, and the VIX has been crushing down below 20 for over 2 weeks now. So the VIX is telling you we are heading into bull market behavior. Right at the same exact moment, the charts themselves are saying the same exact story. It is only if the VIX starts spiking above 20 that we can get more cautious, because the VIX this low is telling us it's a low fear bull trending market. And then finally, we'll take a look at Bitcoin yet again, because I consider Bitcoin one of the most risk-on assets that somebody could possibly buy or invest in. If you look at Bitcoin's log chart, we have very clearly broken out of the bear market resistance trendline, and we have just continued to bull flag above the 20-day simple moving average. This is very bullish behavior and a super risk-on asset, which means there is the possibility risk on asset is coming right back into the market. Now, if you look at the price action on Bitcoin, it is extremely impulsive to the upside, and as I told you in the indices, you always want to trade in the direction of the current impulses in the price action. During this entire time Bitcoin was crashing down, we have very large impulses to the downside, and we had very choppy moves to the upside before the next impulse to the downside. Now we're seeing the exact opposite behavior in Bitcoin with impulses to the upside, bull flagging, choppy behavior to the downside, which means Bitcoin is very likely going higher. In the first place I believe Bitcoin would be trying to get to is going to be between 25 to 30,000. So again, all of the evidence is there with the price action and the trend, and it's all 100% objective. So just to pull this all together and summarize, I've gone over exactly why this is objective bull market behavior, and if you're simply following the price action, it is very difficult to say that this is not a bull trend. And if you do want to get bearish, you really need to wait for the market to roll over and die, because this trend is strong enough to sustain until March and possibly even into the summer. So hopefully this helps you see the bullish scenario of why February could still be bullish even after a bullish January, and definitely why we're expecting to see higher prices into March. So I hope you enjoyed this special update. If you're interested in my trade alert service or my stocks channel Discord, you can find out more information about both of those in the description below. Bank Trade Alert sends you all of your buy and sell alerts via email and text message, and only trades at TQQQs and SQQQs. In the stocks channel Discord, you will get access to all of my intraday updates and analysis and my members only videos. So thank you for watching, everybody. I hope you're crushing this market, and as always, I will see you in the next episode.